All right, welcome back. Our call of the day today is RTX. Look at that. It's hit with a third downgrade this week, this time from Bank of America. They call it a value trap. You just threw in a towel on this, didn't you?
Yeah, enough.
It's down 26% year to date, so I guess that's what you mean.
Yeah, I mean, look, let me make myself feel better, Scott, by pointing out that in the 3 years I've owned it, it's up 9% on average, but I don't feel good, okay? Having said that, look, this was not supposed to be a turnaround story, and that's what it's become. It was supposed to be a solid performer, providing jet engines to the aerospace community, providing missiles to the defense community. Those should be growth businesses right now, and they've messed up.
You've said throughout, I'm just going to stop you for a minute, because we've had a conversation repeatedly since the beginning of the year, if not before, about the defense sector and why you remain so bullish on it. You know, the idea that these conflicts aren't going away. Everybody knows how everybody feels about just that as a topic, okay? But nonetheless, you've said repeatedly that that was going to be good for these stocks, and it hasn't.
And it hasn't been,
Why?
Scott, because of margins. Because of margins, all right? And it's every single one of these companies. It's Boeing Defense, it's Lockheed Martin, it's Northrop Grumman. They all have the same problem. It's margins. Yes, some of this is the hangover of the pandemic and supply chains. A lot of it is labor. A lot of it is finding quality labor to craft these high-precision parts.
But I've heard from a lot of you guys, war is not going away. These conflicts are here. We're going to keep producing. Defense spending is going to continue to go up. I've heard that repeatedly, and now I look at a stock that's down 26%. I'm not, faulting you specifically. I'm just saying what the narrative on this program has been, and then I look at a stock that's had a disastrous performance, and now you're a seller of it.
So let me do specific to Raytheon, then let me come back to the bigger picture. Raytheon, this geared turbofan engine, all right, it just keeps getting worse and worse. This is a major cash cow for them, and they're now spending something like $3 billion in negative free cash flow to fix a problem. That means that this, by the way, the street is not convinced that that's the bottom line number, okay? So to the value trap comment, people aren't really sure this is the number, so this is not going anywhere anytime soon. To your bigger picture question, which is rightfully asked, eventually these margin issues will be worked out, and I'm sorry to say that the top line growth story is intact for defense.
I mean, the ITA,
but without margins,
by the way,
it doesn't matter.
The ITA as a sector has underperformed the S&P 500
At some point, these
This just may be the dog with the most fleas on it from a stock standpoint, but the sector as a whole, if you've been buying the ETF on the recommendations of some on this program, you still have underperformed. Margins.
At some point that gets worked out, but there's no sign of it in these companies. There's no sign of it. So I'm moving to the sidelines. I could see these margins getting worked out. Margins is about management. That's about execution by management. Hasn't happened at any of those companies that I've listed so far. Boeing, Lockheed Martin, I can go down the list again. I don't need to. Let's just wait on the sidelines and see when better management execution appears.
All right, that's fair enough. Again, Jim Lebenthal selling RTX this morning. And that's one of the reasons why we wanted to do call of the day. It just obviously flows and makes the right sense there. FedEx, by the way, Jason Smite, positive mention, Goldman Sachs, ahead of earnings next week. You own FedEx?
Yeah, so obviously FedEx has been a huge winner this year, up 47%. Yeah. Very difficult year last year, however, so let's be clear on that. For me, as I look at obviously bankruptcy of Yellow, redistribution of spend, obviously FedEx will take advantage of that. Also, the structural cost cutting. They have about $4 billion that they're going to cut potentially in 2025, another $2 billion in 2027. I like this name. I mean, when we look at the consumer and goods to services, there is some concern there, but I think with a new CEO, focus on shareholder value, they upped the dividend about 10% in the last quarter, so I like this stock.
Hey, Weiss, didn't you own FedEx at one point not all that long ago?
I did, sold it prematurely, clearly. Look, there are definitely a lot of tailwinds here. I mean, you had some of the UPS business move over to FedEx when they were concerned about the impact of the strike. As Jason mentioned, Yellow going out of business, I mean, that helps pick up pricing, and it also helps ship volume to FedEx. However, on the headwind side, we are seeing a slowdown, despite the number today, in consumer purchases, and that's going to impact them. I believe, though, that with the new management, they put enough in the tank to make sure that they have another good quarter. So I would expect the quarter to be good and also guidance to be okay. But at this level, I'm content to wait on the sidelines. It's not where I want to add exposure right now. I've got enough exposure, and by the way, pretty significant exposure.